Now, to help us synthesize this to get you through August and into the autumn is James Bianco. Jim Bianco writes a wonderfully eclectic note for Bianco Research out of Chicago. He is appearing with us only because the Chicago Cubs are in first place. Jim Bianco, I loved what you said there about tips, about this enigma of where tips are. Give us insight on how unusual these inflation-adjusted statistics are.
The problem is the Federal Reserve is the biggest player in that market. Since March, they've bought $250 billion worth of tips. And if you're looking at the tips market and you're trying to discern a signal out of it about the outlook for inflation or the outlook for the economy, you have to be careful that it's a bit distorted because the biggest buyer is the central bank. Now, it doesn't mean that it should be ignored or not looked at, but it is become more complicated to try and understand it.
What other signals have value to consider inflation?
You know, that's a good question because you'd have to go away from the signals that are not with the central bank. The surveys of inflation like the University of Michigan survey or the Consumer Confidence survey or the commodity markets themselves, the central banks are playing in those markets, and those numbers are turning higher. And they are expecting more inflation as we move forward from here. So there's definitely signals on the horizon that inflation's coming. You could argue the tips market is saying the same thing, but I'd be a little bit careful in overreading the tips market. I want to try and rely on some of those non-market indicators.
And so, good morning to Jim. Talking about other indicators, how confident are you that inflation readings, we just got some out of the UK this morning, inflation a little bit stronger than had been anticipated, but that might be short-lived. How confident are you that inflation readings are giving us accurate information, given the way our spending patterns have shifted so much? The basket that the statisticians rely on might not be the basket that you and I actually consume.
That is absolutely right. That, you know, in the pandemic, especially with the move to online, that what we are consuming now is what we weren't consuming 4 or 5 months ago, so that there could be a bit of a distortion. But at the end of the day, let's remember what's going on, which is the fundamental for pushing inflation higher. We have a higher unemployment rate. We're producing less stuff because the economy is at a lower level than it was a few months ago. And we're stimulating the economy by giving people either stimulus checks or extra unemployment. I know it rolled off on August 1st, but that might come back. And so we've got less supply, and we've got demand being stimulated, and that imbalance should lead to higher prices, otherwise known as inflation. And I think that that's what a lot of the surveys are telling us might be coming.
But knowing what we know about the way the central banks want to keep costs or keep the costs of funding debt low at this point, do we really think that? Do we really see inflation coming meaningfully, Jim? I suppose a lot of people talk about inflation and they just mean, you know, we've bounced up, expectations have bounced up from the lows of March, but that doesn't necessarily mean we're off to the races and inflation goes much higher from here.
Yeah, you know, that's a good point. And I do think that we are going to see meaningful inflation probably in the second half of 21 or into 22 as the economy strengthens and all the stimulus starts to add in as well, too. The central bank, especially the Federal Reserve, is going to go to something called an average inflation target. They're going to say 2% is not their target. It's their average, so they can run it above 2%. Bear in mind, they're not going to change policy 1 inch. They're just going to announce that the target has changed as well.
Come on, Jim Bianco. This is as rare as it can be. This is like when the White Sox are better than the Cubs, and that only happens once a century. Is there any evidence out there whatsoever that governments can reflate an economy, that governments can, you know, somehow magically make 2 or 2.5 or 3% inflation appear?
No, there's no evidence at all. In fact, 2.5%, 3% inflation at the core level, we haven't seen that in 30 years. It was the early 90s the last time. And you know, I should go you the other side of the equation, too. If you ever got to 3% or maybe a little bit more in inflation, there's very little evidence that the governments or the central banks could stop it if they wanted to stop it.
I mean, I don't want to go all Nellie Fox on you here, but let's stay with the White Sox here right now just to bust your chops. But Jim Bianco, what is so important here is the Fed and their timeline. Do you just assume their timeline is way out past what the zeitgeist is, that it's 23 or dare I even say 2024?
Yeah, I'm going to go White Sox with you, too. They want a Richie Zisk home run that's going to go into the upper deck and hope to keep it rates it zeroed out to 23 or 24. But they're only going to kind of do it one meeting at a time. They're going to give you forward guidance. There's going to be no inflation. And then when it starts to percolate too much, they'll change it and dime. Now, that's not going to happen right away. But I suspect that when all is said and done, they'll be moving on inflation a lot sooner than they think, probably in a year to 18 months as opposed to 2 or 3 years.
Jim, you know, you do a lot of different things, the bond market. I loved your tips work as well. I want you to address for our listeners and viewers this stock market. It seems to be uniquely and differently unloved. How do you participate?
You know, that's the stock market, I'm going to push back. I understand people have said that it is the most hated bull market ever. We were saying that pre-pandemic. We're saying that post-pandemic. But there are plenty of instances or signals that the public is in a big way. The Robinhood type of retail accounts, which now account for 25% of all the volume, which was practically nothing a couple of years ago. They're in a big way, too. They're in a big way in the concentration you see in the FANG stocks. Those are almost a quarter of the S&P. You got to go back 50 years to find 5 stocks that had that big a weighting in the market. So they're in that market. And I think as far as to your question, the reason that they hate it is those bottom 300 companies, I think they're still struggling with the economy to return to normal. But those top companies, especially those top 20 or top 5, they're stay-at-home companies, and they're doing very well, and they're pushing the whole index higher.
Jim Bianco, thank you so much. Just brilliant. We love the Cubs. Jim Bianco there from Chicago.